Hi, everyone. Okay. Hi, I'm Adam Levine. I'm the founder of Levine Capital. I am a hardline lender, private lender, creative finance expert, understand all the nuances of this hot topic, gap funding. We do a lot of, I'm a part of the Gator community. I'm part of Sub 2. I'm also a member of Owners Club and super excited about this topic, gap funding. So, waiting for people to join us. I know we started a little bit late today. There will be a replay as well. So, gap funding, what is that? It's exactly the way it sounds. It's you're filling in a gap, right? Typically, gap funding is something that people look for on, let's say, a fix and flip. Okay, usually will cover, let's say, the down payment, the equity required for the closing costs, could cover interest payments, could even cover, let's say, the first draw. Because what happens is borrowers, they will get from a lender construction holdback money, but they have to put up their money first, and then they get reimbursed from the lender like a bank, right? They'll get reimbursed for the so they put out $10,000 from demo, whatever. They put a draw request in. The lender will reimburse them $10,000 dollar for dollar. Usually they'll get 100% holdback. There are times when they'll get less, but that's another subject. So um, we we work with a lot of investors, and a lot of people want gap, but I get a lot of calls daily. I had a call this week. Oh yeah, I saw you. I googled you, and I was watching a YouTube video, and I have a lender lined up, and I need gap funding. I'm like, that's great. However, we used to gap fund behind other lenders, and I just want to keep in mind, if you do want to work with Levine Capital, myself, or um, you approach us for gap funding, we now really prefer to do both loans. We work with mostly a lot of institutional capital and private capital. Okay. So we like to blend both of them, and we prefer to be the institutional lender, and then we'll bring the gap funding behind our institutional loan, and we can even cross collateralize that against other properties. And we'll rather be the one-stop shop for everybody. It just makes everything easier for us. It also mitigates risk at our end for us as a gap funder, or if we bring in other gap funders. Why is that? Because we don't know the economics of the first position of the hard money loan. It could be a 6 month term. It could be we don't know the way they work with draws. We know nothing. I mean, what could be really something terrible that something that could really hurt a project is if the lender holds up their holdback monies. Borrower, they request a draw, and let's say they got to wait a week just to get their monies back. Now they're stuck in limbo. Well, with Levine Capital, we could reimburse your money within 24 hours. Usually, a lot of times it's the same business day, so it keeps the velocity of money going. So whenever we um, structure gap funding, we always typically like to structure it behind a minimum 12-month institutional fix and flip loan. And we'll also set it up where we have virtual inspections. So the reimbursement of the construction holdback monies is within 24 hours. We like to, we like to make sure that there's a healthy profit for the borrower, because at the end of the day, we want to make sure that the, the borrower's making money. He's not working for free. We want to make sure that the gap funder, there's enough profit for him to get paid back his principal plus his return on his investment. And it's really it just makes more sense for us if we do everything in house. And also, like, if you're a borrower, it's easier to work with us. Everything is streamlined with us. We can underwrite the fixed loan. We can underwrite um, the gap funding. You don't need to talk to other lenders. We'll give you great economics. We will handle everything in house. Also, if you're let's say, a broker, and you have a client that needs gap funding, keep in mind that we do require all counterparties to sign a confidentiality agreement because a lot of stuff that we do is proprietary. We do everything in house. We like to keep things within what we're doing. So we do require confidentiality agreements, and so we'll have you sign one in your client. And in reality, it's a way for you to make more money on your loans, where you could make a broker fee and make lender fees as well. Um, if you're a gator or a connector, you could work with us as well. We could be your one-stop shop. Let's say you're working with a plethora of gap funders, and you're a connector, and you have borrowers are coming to you for gap funding. Well, great. We could be your go-to institutional hard money lender, and we could mitigate risk on all levels. We'll show you everything. As long, obviously, we need the borrowers. We'll let the borrowers share their personal information with you, because there's regulations on that. However, as long as the borrower's okay with it, we can show their appraisal. We'll show everything that, so the underwriting. At least you can see how we underwrite and everything. And we'll go through it and say, hey, you know what? There's not a lot of profit. However, they may have cross collateral, rental properties. Take a look at that. We know a lot of TCs, transaction coordinators, we could pair you up with, title companies. So as a connector, we understand how you make your connector fees. Well, you may be leaving money on the table, where now you can actually make lender fees. You can make a broker fee as well, and make a broker fee and a lender fee. We could disguise your, maybe do one-on-one, do one broker fee, one lender fee. And after we close, we'll just wire you the money, your lender fee after we close. We could potentially talk about white label. It's a whole nother subject. We could talk about that on another discussion off YouTube. But it's something that that I'm very passionate about, and I know been doing this for years, and we understand a lot of the nuances. So I can help you definitely structure these deals creatively. So if you're a borrower, one-stop shop. If you're a connector, one-stop shop. You're a broker, one-stop shop. And we leave great economics for brokers and connectors to make money on these deals. If you're a gap funder, and let's say you are the gap funder and you are being presented many gap funding opportunities from connectors. Well, an opportunity for you is to work with us. There's a few ways you can do it. Number one, you can steer your client to us, or your borrower to us, and you could do the same thing. You could be a gap funder as well as the connector. You could make lenders, so you could double dip. You could make your fee on your return on your investment for the money you're laying out for the gap funding, and you could make lender fees or a broker fee or whatnot. Let's say you're a gap funder and you are looking for deal flow. You could come to Levine Capital. We have lots of deal flow, but we're very picky on the loans we like to fund with gap funding. We do turn down a lot of them. It's just really at the end of the day, we like to like, it has to make sense. I mean, if there's no profit in the deal, then, and the borrower, guy or gal, doesn't have cross collateral, it doesn't make sense for gap funding. It's just a terrible idea, and we won't even. But we'll have to explain it to the borrower so they understand. It's like, look, this is not a good idea. They may not like it, but at the end of the day, it's just going to put everybody in a bad position, and it's not. We like to do good business. Pardon me on that on my phone. Part of my face too. I've been doing a lot of Brazilian jiu-jitsu, so my face is baked up and growing like 5-6 times this week. And let me kind of show you something too. So I know I'm going off a lot right now, but let me show you how you could submit opportunities to us now, because a lot of times people are coming to me, and it also goes with mortgage methods too, or goes with any type of creative financing, or even just you just need a fix it flip loan. Let me show you something real quick. So let me go to my website and let me know if you ever need any recommendations on what we could do for our website. I'm always open to recommendations. So let me show you something real quick. So I'm gonna go to the website right now. Okay, here's levinecapital.com, right? So this is a little video that shows you how to submit a loan to us. We're going to update these videos. We're constantly updating things because whenever someone has a question, it sparks the idea. It's like, hey, you know what? Maybe I can create a video or create a Q&A or something with AI to answer. We have a chat bot. We use an AI agent, voice agent to help. So many different ways, and I always appreciate questions. So going back to here's a little bit about the fix and flip, fix to rent. I mean, this is the standard loans, and then this talks a little bit about the gap funding. So thanks to Pace Morby, respect Pace. We'll be seeing them in Monterey later this month, part of the Owners Club. Pace with the Gator method really set the standard with the gap funding, the Gator lending, which Gator lending really, it's a broad term comprising of many different types of, I would say, creative finance loans, which is going to be gap funding, urged by deposit loans, could be bailouts. I mean, it could be factored in so many different ways. That to me, that's the way I look. It's more creative finance. So Gator lending or gap funding falls under the umbrella of Gator lending. Okay, not everybody knows the term, but it's becoming more accepted now these days. I mean, I remember 5, 6, 8 years ago, gap funding. I mean, it was a lot cheaper. It was not a flat fee. It was more of an annualized return, maybe 20%, maybe 10%, maybe 12%. Annualized. Obviously, you have to be within the below usury. Obviously, there's no way around that. Every state's different, but with respect to that, it Pace has really changed the industry, and this is just from having conversations for many years. Whereas if I was to let me step back. So gap funding, right here, we're saying, typically it's a 6-month term, extendable to 9 months on a case-by-case basis, could even go to 12 months. I would say generally gap funders don't want to be in 12 months. I would say for them to be in longer, there's got to be a compensating factor as what are they getting in return. Obviously, they're going to want a longer, more of a return on their investment. If it's, and this is something too with gap, with borrowers, when you're negotiating terms with a gap funder, in reality, the gap funders look at that of their opportunity cost. So if they can make 15% or 10% in 3 months, let's say, but they got to stay in 6 months. Well, they may want 20% in 6 months because now, if their money is stuck in 6 months, they're only making 12%, and they can make 10% in 3 months. Well, opportunity cost, they're losing money because that money's tied up for 6 months. Meanwhile, they could have maybe went into 2-3 month deals and made 20% rather than being in a 6 month deal for 12%, right? But so you have to just think of way of what are they, it's recycling capital. I put my money into 3 months, I can make 10%, great. So what does that translate to? So when you're negotiating terms, maybe you say, hey, you know what? Maybe we'll have a 20% or maybe 18% flat fee or something like that within 6 months. But if I get you out in 10 months, let's do 10%. If 15% or 18% in 6 months. So you basically the borrower is incentivized to get you out of the deal faster because he's paying less. But if it goes longer, they're going to be compensated. Maybe it is 20%. They're like, 6 months is 20%. But that's up for you guys to negotiate terms. Now, if you want longer terms, there's probably, I would say, there are probably structured as like a penalty. Look, you went past, 6 months. There's an extension fee. This is what's going to cost you if it goes 9 to 12 months. I put that there as a guide because this is what I'm seeing in the industry. I said $50,000 maximum amount. Look, the potential to increase on case by case basis. Usually it's more than 50,000. But it's easier to find a gator for 50 than rather than 150. You may have to pull multiple gators or they'll just partner. Multiple gators will just partner on the deal, on a loan, basically to aggregate the capital to bring it to 150. Starting rate is 15%. Usually that's a 50% return on their investment. Usually it's so the gators are like flat fees these days. 15, I would say 15 to 30%. The shorter timeline, less they'll expect, longer they'll expect more. And these are also private money lenders, let's say. So really, PACE has really changed the industry. And what's interesting is now a lot of borrowers, they know that it's like when you tell them this is what it is, they're like, yeah, right now. Versus 8 years ago, they're like, what are you crazy? They'll never accept it. It just wouldn't happen. Which is, it's good for lenders. It's great, actually. I love it because now it's an easier conversation when I tell them exactly, I'm like, look, we can help you with the fix and flip loan. This is what it is. And now gap funding, this is what it is. And it's an easy conversation. They digest it. They understand it. There's no, and that's it. It's, so thank you, PACE, on that. Now everybody has different underwriting. I would say cross collateralization is something that helps underwriting because generally the gap funder, if they're savvy, they're not going to want to exceed, let's say, 70% of 70 to 75%, but it depends upon where we are in this cycle. If you're more risk averse, you may want to not go above 70% of the combined after repair loan to value. I'm seeing a lot of gators now; they're becoming more aware, more risk adverse because there's a lot of data, or let's say a lot of other gators that are basically, sorry about my phone, that basically had a bad there's a lot of bad deals that have happened, whereas underwriting gets tightened up because originally everybody's aggressive, like, yes, this is easy, I can make a lot of money really fast, and all of a sudden things go bad between borrower and lender. Borrower's money, the lender's money is tied up, they're losing money, whatever it is, and now they're like, okay, they're tightening up, basically, a high level view. So now underwriting has changed, and even for institutional loans, same thing. When there's a lot of data, things change. When there's recession risk, lending tightens up. When everybody's very optimistic, they start to loosen things up, right? So I would say you want to really stay 70% of the combined loan to after repair value. Most hard money lenders will go up to, let's say, 70 to 75% of the after repair value. Now, when you bring a gap funder in there, if you're at 70, maybe you can squeeze it to 75%. That's the combined loan to after repair value. So maybe you have the hard money lender at 65 or 70%. And then the combined loan to after repair value is at 75. So maybe you could squeeze a little more in there. When you're squeezing it to 75% of the after repair value, keep in mind it's a tight deal. When you have to squeeze it, increase the ARV on the institutional loan, it's a tight deal. The numbers are tight. So a compensating factor is cross collateral. Gators will ask for cross collateral just to have more equity protection. Now, this is kind of like a little high level view of what we have. And then we also have another place on our website where it shows gap funding here. What is it for? Like I mentioned before, down payments, closing costs, first rehab draw, interest reserves. Obviously, you need to put money down. Most lenders require money down. Could be 10%, could be 5%, could be 20%, could be more, right? And basically that's the equity. So the gap funder will fund the equity, right? Then there's closing costs on top of the equity. They can fund the closing costs. Going back to first draw, a lot of times when there's an initial release, let's say the borrowers get 90% of the purchase price, so they're getting 90%, but there's rehab money. They have $50,000 holdback, construction holdback, right? Well, they're not getting that money up front, so the gap funder could fund that up front, right? So now they could get the project started rather than maybe, who knows, maybe they're short on cash, or maybe they have cash, but they'd rather use OPM, other people's money, and keep that money here for, just to have a nest egg. Like, they want to have reserves for themselves. Smart people will have reserves just if something goes wrong, because things will go wrong, and it's good to have reserves. If you're just coming, by the way, if you're coming into this space where you're looking to borrow money and have no money, that's a very dangerous game to play, because you will go over budget. Things will go wrong, and if you don't have capital or access to capital, that is a recipe for disaster. It will happen, and that's all I really could say, in my opinion. So when I like to lend people money, or if a Gator that's lending people money, you really want to make sure that these people have some equity. Maybe they're equity rich, cash poor, or they have some money, but some liquidity, whereas they could cover themselves if they need it, or they have access to capital. Because it's really, if they don't have money going in, and they're looking to pull money together, but they don't, things can go wrong real fast. Example, cost overruns. I've seen it happen a lot. You will go over budget. It's going to happen. It's just how much will you? And that's when someone will come to me. They're looking for a mid construction refinance or a midstream refinance, meaning that they're mid construction and they don't have enough money to get to the next draw. They may have like 75% or 50% of their rehab budget still in holdback, and they can't get to it because they don't have enough money to keep the project going, to get to the next draw. And then they'll come to me or someone to bail them out. That could be a problem for a gap funder. So you got to be careful of that. Interest reserves. Some lenders require interest reserves, and maybe because typically home loans are monthly payments. So you're going to want the gap funder to give you, let's say, 12 months or 6 months or 9 months, just to be on the safe side, or 3 months to cover interest payments. Because still, when they take out a loan, they're going to need money for down payment, closing costs, to get the first draw, and interest payments every month. And as a lender, we could help all counterparties structure that. And we're really good at that. Working with us as well, one-stop shop, streamlined underwriting, coordinated documentation, fewer delays at closing. And we can fund up to 100% total financing with proper collateral, right? Now, a few things, right? So if you want to submit opportunity to us, you can always book a call with us, by the way, as well. Let's say you want to submit opportunity to us. It's very simple. Um, if you're a borrower, just put you're a borrower. If you're a broker, put you're a broker, you're a connector, wholesaler. And what happens is if you put yourself as a broker or connector, which is the same thing, you're going to be emailed rather than the borrower. You still put the borrower's information in there, but you're going to be emailed. Don't get stuck on all the fine details. Just get it into the system. It takes about 5 minutes or less. You'll get an automated email. From that automated email, you can go back and fix things. So let's say you're a borrower, right? You're going to choose your loan product, fix and flip, right? What's going to happen is it's going to ask, need gap funding, second position to cover down payment or costs. Just put here, like yes, no, maybe, that's it. This is going to, you can also put your desired leverage. We can go up to 95% loan to cost without gap funding, keep in mind. But putting this gap funding, need gap funding, and you put yes, this is going to trigger us to treat this differently, and basically will trigger something internally so we could structure the gap funding deal. And that's really basically it. It's really simple. So what I want to tell everybody is if you're a broker, we could be a one-stop shop connector. So for everybody that's joining again, let's say you're a borrower, and we've done it plenty of times where it's like, okay, I already got an appraisal ordered with another lender, and now I need the gap funder. Or I had a gap funder, but the gap funder, he bailed on me. You don't have the money. And it happens a lot. I mean, I get these phone calls all the time. So we really prefer to do the first position loan with the gap funding. We could possibly use that appraisal if you transfer it to us. We can close. Look, fix and flip loans, institutional, we can close in 10 days or less. We've done it in as little as a week. Gap funding, I always like to say 2 to 3 weeks. Could be faster. But I like those be pessimistic and be just be very on the safe side and tell you 2 to 3 weeks. There's multiple reasons why, but that's just the time frame. We've closed one recently where the person didn't really need the gap funding, but he closed his own equity, and now we're setting up the gap funding after. But not everybody has that luxury, okay? Generally, most of the time, people, when they close, they want the gap funding to be there. And then we close and have it, so everything happens simultaneously. And that's really it. I mean, we want to be your one-stop shop. So anybody, before you go to another lender, come to us, submit everything here. Everything's in-house. It's easier. It's more efficient. You're going to have the confidence that it will get done. And we're going to tell you, we're straight to the point. We'll tell you, yes, if it can work, or no. And this is, what could go wrong. So you really need to know your values. You need to know your numbers. We could look internally, but at the end of the day, it's like, if you send us a deal and you're like, oh yeah, I don't like you. If you can't find comps, like because on our automated email, you're gonna get an email, show us 3 comps. Go talk to a realtor. If you're having a hard time finding comps, then it's a high probability of appraisers is going to have a hard time finding comps. We do require appraisals. If you do have an appraiser that you recommend, we can always try to onboard them onto our panel. Probably my back is killing me just for rolling with the jiu-jitsu this whole week. So it's like tightening up on me. But I mean, there's always things that can go wrong, appraisals or whatnot. But in reality, we try to mitigate that by seeing if you have comps, and you're going to get that in that automated email. And that's pretty much it. I mean, there's definitely more things I wanted to share, such as the same thing as a Morby method. So now which is kind of gap funding in a way as well. Short-term gap funding, at least. It's like transactional. But let's say you choose DSCR loan. Now you could actually because we're getting a lot of requests. So now you could check off, is this a mortgage method deal? Seller finance plus DSCR. Yes. So this basically, got a request from today. Someone is a transactional lender and needs a DSCR lender that understands seller finance transactions, mortgage methods, how to structure it, and how to obviously get the deal done. We're your one-stop shop. If you're a connector broker or you're the lender, transactional lender, then we could be your go-to lender for mortgage methods, or go-to lender for like the DSCR loan or fixed flip. So keep in mind, mortgage method or seller finance deals do work on fixed flip, and they do work on DSCR loans. There are more moving parts, but we closed a good amount of them, so we understand all the nuances on that. Same thing, you select this. If you want to pre-screen something through us, it does not need to be under contract, and you can even request approval funds. We do also run soft credit pulls as well, which helps because it would not ding your credit. A lot of times people will look on Credit Karma or maybe the online banking, they see their credit score, and at the end of the day, it could be off or way off. You could come to us and just get a soft credit pre-approval where we will run your credit score, which is a soft credit pull, will not affect your credit. You will know for a fact where your credit score is. Fix and flips, we typically like a 680 credit score. We could go lower to 620. There are compensating factors why we go lower on credit, which is usually experience, which counts a lot. Interest reserves required on the loan. But the DSCR loan is really, really sensitive to credit. And if you're bringing in gap funders on a fix and flip, and you're, let's say, fix and flip, which is the loan product, you're buying the property, renovate it, either sell or refinance. The thing that could go wrong is the credit score could go down, and usually that happens because the borrower is using personal credit, such as personal credit cards, to fund their rehabs, which then their exit is to refinance. And the DSCR loan is sensitive to credit, which you typically want to have in the 700s to get us the higher leverage. When you start dipping into sixes, you're not going to get the same terms or higher leverage with the lower rate. And that could basically make it challenging for the refinance and for the gap funder to be paid back. So it's a whole other discussion we could have, but another tool is like we could run soft credit pulls from the beginning to make sure that the numbers work on the loan, either for a fix to rent, which is you buy, renovate, and refinance to DSCR, and that's the exit. But in my opinion, you should always have a fallback analysis of a sale just in case you can't refinance, right? Or if you're looking to sell as your main exit, would fall back. Let's say the market slows down and, whatever days on market are longer, things aren't selling, whatever it is, you could refinance to a long-term rental, pay everybody back, right? We could run soft credit pulls throughout the whole project just to make sure that we're not going to run into any surprises later on. So that's another value that we offer. I would say check out also our partners. We do have a lot of affiliate partners. Business Credit Workshop, Joe Lawrence is amazing. Check this out. This is more of a mentorship, a big community. It's really, what this does is it gives you the tools to do it on your own, and you have support of a whole community. Getting business credit is one thing. Taking it to another level where there's no limit to how much you can get. It's a strategy, and this is well worth it. Gator sub 2, amazing. We have different affiliates. Prime Corporate Services is another one that they offer business credit as well. They'll help you do things. I would say that basically you're gonna want to build business credit. It's a whole other thing we could talk about. I have some YouTube videos on that, but I would definitely look into that. And that can also help you fund your gap funding as well. That could be your reserves that I was talking about, where you have money in reserves. Maybe it's not cash per se, but you have a business line of credit or access to business credit cards where you can convert the business credit card to cash to cover things. And that's really what I would say savvy investors would need that. Now, anybody have any questions at all? I know I've been going on for a while. It's getting late. And so, okay. So this is what I want everybody to do. After you're done watching this, just let me know if you have any questions. Just let me know. Ping me. If you have a loan you want to pre-screen by us as a connector, broker, wholesaler, please just come here. If you're a broker, sign up as a white label private lending or referral partnership or broker partnership. Just sign up and we can work with you. If you're a borrower, you can come in here. You can get approval funds if you need. We get you pre-approved with us. We can start talking numbers. All right. I appreciate every one of you. I hope everyone has a blessed weekend. Thank you so much. Bye now.